"You're just a secretary." That's what Martin Crawford said on September 14, 2024 at 2:47 p.m. during an executive meeting in the boardroom of Crawford and Associates, waving his hand dismissively when I tried to clarify a discrepancy in the financial projections he was presenting to potential investors, his tone suggesting that administrative assistants should take notes quietly rather than questioning numbers that didn't match the documentation I'd been compiling for the past 5 years, 2 months, and 17 days. The mahogany conference table reflected the afternoon light coming through the floor-to-ceiling windows, and 8 people, 3 potential investors, 2 board members, the CFO, Martin's business partner Daniel Reed, and Martin himself, sat around the table reviewing slide decks about Crawford and Associates' financial performance while I sat in my usual chair against the wall with my laptop open, typing meeting minutes that were considerably more detailed than anyone in that room realized. I'd been executive assistant to the managing partners at Crawford and Associates since March 2019, attending every executive meeting, every board meeting, every investor presentation, and every strategic planning session, taking meticulous notes that went far beyond the official meeting minutes and included direct quotes, exact numbers, timestamps, and detailed records of decisions made, promises given, and policies established that would later be contradicted or conveniently forgotten when those policies became inconvenient. I'm Rebecca Martinez, and I sat against that boardroom wall knowing exactly what my 5 years of comprehensive documentation contained. Verbatim records of Martin instructing the accounting team to defer expense recognition until next quarter, in March 2023, detailed notes of Daniel directing HR to classify full-time employees as contractors to avoid benefits costs in July 2022, time-stamped accounts of board meetings where executive bonuses were approved based on revenue projections that both partners knew were inflated by recognizing future revenue in current periods, and precise documentation of approximately 140 separate instances where Crawford and Associates leadership made decisions that violated company policies, accounting principles, employment regulations, or the representations they'd made to investors and clients. 5 years, 2 months, and 17 days of being invisible in meetings, dismissed as just a secretary, treated as furniture that took notes and scheduled appointments, while I documented every word spoken, every decision made, and every ethical boundary crossed by executives who thought administrative staff didn't understand financial statements, employment law, or the difference between aggressive accounting and fraud. I wasn't the chief financial officer who prepared financial reports and signed off on accounting decisions, or the general counsel who reviewed contracts and advised on legal compliance. I drove a 2017 Nissan Sentra with 112,458 miles and a back seat containing printed meeting agendas and reference materials I reviewed before each session because understanding what executives were discussing meant I could take more accurate notes and identify when statements contradicted previous representations. I lived in a 740-square-foot apartment in suburban Chicago with a home office containing external hard drives with encrypted backups of every meeting recording I'd made with executive permission. They'd approved audio recording, for accuracy in minute preparation, without considering that those recordings would document everything they said rather than just the sanitized summaries that appeared in official minutes, printed copies of meeting minutes organized by date in 3-ring binders, and spreadsheets tracking contradictory statements and policy violations I'd documented over 5 years. I was methodical about documentation, careful about accuracy, and protective of records that proved exactly what executives had said and when they'd said it, and apparently Martin and Daniel thought these characteristics made me just a secretary, rather than the person whose comprehensive documentation is the only complete record of what actually happened in meetings where decisions were made. I joined Crawford and Associates in March 2019 when they were a mid-sized consulting firm providing business strategy, financial advisory, and operational improvement services to middle-market companies. The firm employed 47 consultants and generated approximately $18 million in annual revenue. Martin Crawford and Daniel Reed were the founding partners who'd started the firm in 2012 and had built it into a respected consultancy in the Chicago market. My role as executive assistant was to manage calendars for both partners, coordinate meetings, prepare agendas, take meeting minutes, handle travel arrangements, manage correspondence, and provide administrative support for executive operations. The position paid $52,000 annually, which was slightly below market rates for executive assistants at comparable professional services firms, but the role provided stability and the partners had assured me there would be growth opportunities as the firm expanded. Part of my responsibilities was attending meetings to take minutes. This included weekly executive team meetings, monthly board meetings, quarterly strategic planning sessions, and various ad hoc meetings with investors, clients, and advisors. The partners wanted comprehensive meeting records for reference and documentation, so they'd given me permission to audio record meetings, to ensure accuracy when preparing official minutes. What they expected was that I would record meetings, transcribe key decisions and action items, and produce brief summaries for distribution. What I actually did was create 2 sets of records, official meeting minutes that summarized discussions at appropriate detail levels for distribution, and comprehensive personal notes that documented everything said, including statements that didn't appear in official minutes because they were tangential, inappropriate, or reflected poorly on leadership. I maintained this practice for 5 years, not because I anticipated needing documentation to protect myself, but because I'd learned early in my administrative career that executives' memories of what was said in meetings often differed significantly from what was actually said, and having comprehensive records prevented disputes about who'd committed to what actions or what guidance had been given. Over 5 years, this documentation accumulated into a substantial archive. By September 2024, I had 287 complete meeting recordings with transcripts, 1,847 pages of comprehensive meeting note spreadsheets tracking 140-plus instances of questionable decisions or policy violations, cross-reference documentation showing patterns of misrepresentation to investors, clients, and employees. I didn't create this archive with malicious intent. I created it because taking thorough notes was my job, and because having accurate records made me better at my job. But the archive's existence meant that I had documentation of things that Crawford and Associates leadership would have strongly preferred remained undocumented. The first significant instance I documented was in July 2022, during an executive meeting about employee benefits costs. Crawford and Associates had been experiencing margin pressure, and Daniel was looking for ways to reduce expenses without reducing headcount or compensation in ways that would be visible to employees. What if we reclassify some of the junior consultants as independent contractors? Daniel suggested. They're doing project work anyway. Calling them contractors instead of employees saves us approximately $180,000 annually in benefits costs and payroll taxes. The CFO, Patricia Morrison, looked uncomfortable. Those consultants work exclusively for us, use our offices and equipment, follow our direction on project work, and are integrated into our operations. The IRS would likely classify them as employees regardless of what we call them. Misclassification creates substantial legal and tax risks. But if they're working on client projects, that's contract work by definition, Daniel replied. We're just being more precise about the nature of the relationship. We'd need to restructure how they work to support contractor classification, Patricia said. They'd need more autonomy, ability to work for other clients, their own equipment and offices. Just changing the paperwork without changing the actual relationship isn't compliant classification. Let's table this for now, Martin interjected. Patricia, can you research the requirements and see if there's a way to structure this that meets compliance requirements while achieving the cost savings? In the official meeting minutes I distributed, this discussion appeared as, partners requested CFO research regarding employment classification optimization for cost management purposes. In my comprehensive notes, I documented the exact conversation, including Daniel's explicit motivation, saves us approximately $180,000 annually in benefits costs, Patricia's warning about misclassification risks, and Martin's instruction to find a way to structure this that meets compliance requirements while achieving the cost savings. Language that suggested the desired outcome was cost savings with compliance as a secondary constraint rather than a primary requirement. 3 weeks later, Crawford and Associates reclassified 8 junior consultants as independent contractors. The reclassification came with no change in how these consultants actually worked. They still used company offices, worked exclusively on Crawford projects, followed partner direction, and were functionally indistinguishable from employees except for their classification on payroll systems. I documented this decision and its implementation, including the fact that it occurred despite Patricia's expressed concerns about misclassification risks. Similar patterns appeared throughout 2022 and 2023. In March 2023, during a meeting about quarterly financial results, Martin directed the accounting team to delay recording certain operating expenses until the following quarter. We're just barely hitting our EBITDA targets for Q1. Martin said, reviewing preliminary financials. If we defer recognizing the IT infrastructure costs and the office renovation expenses until Q2, we'll comfortably exceed targets. Those are long-term investments anyway. There's flexibility in when we recognize the full costs. Patricia hesitated. The expenses were incurred in Q1. Accrual accounting requires recognizing expenses in the period they're incurred, not when it's convenient for reporting. But the benefits of those investments extend over multiple quarters, Martin argued. We're not misrepresenting anything, we're just being thoughtful about matching expense recognition to benefit realization. That's not how accrual accounting works for these types of expenses, Patricia said carefully. The principle is matching expenses to the period they're incurred. Let's recognize half in Q1 and half in Q2, Martin decided. That's a reasonable compromise that reflects the ongoing nature of the benefits. Official minutes. Partners approved phased expense recognition for Q1 infrastructure investments. My comprehensive notes. Direct quotes showing Martin's explicit motivation was hitting EBITDA targets, Patricia's explanation of proper accounting principles, and Martin's decision to override that guidance with compromise language that disguised the fact he was directing expense manipulation to meet financial targets. These weren't isolated incidents. Over 5 years, I documented 23 instances of expense timing manipulations to meet quarterly targets, 17 instances of revenue recognition decisions that pushed boundaries of appropriate accounting, 8 instances of employee misclassification or benefits policy violations, 12 instances of misrepresentations to investors about company performance or growth projections, 34 instances of client billing practices that violated firm policies or contractual agreements, 46 instances of various other policy violations, compliance shortcuts, or ethical boundary crossings. Each instance was documented with dates, direct quotes, context, and outcomes. Many individual instances weren't dramatic frauds or major violations. They were small shortcuts, minor manipulations, ethical compromises that executives rationalized as business judgment or being practical about rules. But accumulated over 5 years, they created a pattern of leadership treating policies, regulations, and ethical guidelines as suggestions to be followed when convenient and circumvented when following them would be costly or inconvenient. I didn't raise concerns during this period because I didn't think anyone would listen to just a secretary questioning executive decisions, and because I didn't have authority or standing to challenge financial or employment practices. I simply did my job, taking thorough notes and maintaining accurate records. My role was invisible to most people at Crawford and Associates. I scheduled meetings, I prepared agendas, I took notes, I produced meeting minutes, I managed calendars, I arranged travel. Consultants passed me in the hallways without acknowledgement. Partners gave me instructions without making eye contact. Board members didn't know my name despite attending meetings where I sat against the wall for 5 years. This invisibility meant people spoke freely in meetings without considering that I was documenting everything they said. Executives had private conversations in front of me as if I wasn't present. Partners discussed sensitive decisions with the assumption that I was recording information, not understanding it. Martin's, just as secretary, comment in September 2024 was neither the first nor the worst dismissive statement I documented, but it was the comment that occurred at a particularly significant moment. During an investor presentation where Martin was presenting financial projections I knew were based on aggressive revenue assumptions and accounting practices that Patricia had previously warned were inappropriate. The meeting on September 14, 2024 was with 3 potential investors who were considering a $5 million investment in Crawford and Associates to fund expansion into new markets. Martin was presenting financial performance data showing strong growth and healthy margins. His projections showed 30% annual growth continuing for the next 3 years. I noticed that the revenue figures he was presenting didn't match the internal financial reports I'd seen Patricia distribute 2 weeks earlier. Martin's investor presentation showed higher revenue and lower expenses for the most recent quarter. During a pause in the presentation, I asked quietly, "Martin, the Q2 revenue figure you're showing is $6.2 million, but the internal financial report showed $5.8 million. Which figure is correct?" Martin turned to me with visible irritation. "The investor presentation uses recognized revenue. The internal report showed billed revenue. There's a timing difference. But the expense figures are also different," I continued. You're showing $3.1 million in expenses, but the internal report showed $3.6 million. You're just a secretary, Martin said sharply. You're not here to question financial presentations. You're here to take notes. Let the executives handle the financial details. One of the investors, Karen Chen from a venture capital firm, looked uncomfortable. Actually, I'd like to understand the discrepancy Ms. Martinez is noting. Can you explain why the investor presentation numbers differ from your internal reports? Martin smiled smoothly. As I mentioned, there are timing differences in revenue recognition and expense allocation between management reporting and investor presentations. This is standard practice. Management reports show cash basis information for operational management, while investor presentations use accrual accounting. The figures aren't inconsistent, they're just prepared on different bases for different purposes. This was not accurate. Both reports were supposed to use accrual accounting. The differences weren't about cash versus accrual, they were about aggressive recognition decisions that made current performance look stronger than it actually was. I didn't contradict Martin during the meeting. I simply made a note of his explanation and continued taking minutes. After the meeting, Karen approached me privately in the hallway. Ms. Martinez, I noticed you seemed concerned about those financial discrepancies. As the executive assistant who attends all these meetings, do you have confidence in the financial reporting the partners are providing to investors? This was a complicated question. I had documentation of numerous instances where financial presentations to investors were more optimistic than internal reality. I had records of accounting practices that Patricia had warned were aggressive. I had 5 years of evidence that Crawford and Associates leadership regularly prioritized favorable presentations over complete accuracy. But I was just a secretary. Criticizing the partners' financial presentations to potential investors would likely end my employment and could expose me to legal retaliation. I maintain detailed meeting records, I said carefully. If you want to understand the company's financial practices and decision-making, those records would provide useful context. Are you offering to share internal documentation with potential investors? Karen asked. I'm noting that I have comprehensive documentation that might address your questions about consistency between internal and external reporting. Whether and how you'd access that documentation would need to be determined through appropriate channels. Karen handed me her business card. If circumstances arise where you believe that documentation should be shared, please contact me. I returned to my desk and continued my normal work. I didn't immediately do anything with Karen's contact information. But I thought carefully about what I'd accumulated over 5 years and what ethical obligations I might have regarding documentation of practices that I believed were misleading investors and violating various policies and regulations. Now about 63% of you think I'm about to leak those documents to the investors or anonymously send them to regulators as revenge for being called just a secretary. And you're wrong about the revenge part but eventually right about the documents being shared. Subscribe right now, because what actually happens is that Crawford and Associates' aggressive accounting practices eventually trigger an external audit, and during that audit I'm legally required to provide my comprehensive meeting documentation to auditors investigating financial reporting practices, and my 5 years of detailed notes, including recordings of executives directing accounting manipulations, explicit discussions of misclassifying employees, and documented patterns of misrepresentation to investors, become the primary evidence in an investigation that results in civil penalties, forced restatements, and leadership changes. No revenge. No leaks. Just complying with legal obligations to provide documentation during an official investigation, which happens to include very detailed records of exactly what executives said when they thought the secretary wasn't really paying attention. The catalyst for external scrutiny came in November 2024, 2 months after Martin's "just a secretary" comment. One of Crawford and Associates' largest clients, Midwest Manufacturing, which represented approximately $2.4 million in annual revenue, terminated their consulting contract after discovering that Crawford had been billing for hours that hadn't actually been worked. The client had requested detailed time records for a project where they'd been billed for 940 hours of consultant time. When they reviewed those records, they found approximately 230 hours billed for work that either hadn't occurred or had been done by junior staff but billed at senior rates. Midwest Manufacturing didn't quietly go away. They filed a formal complaint with the State Consulting Board and sent a demand letter to Crawford and Associates requesting a full audit of all billing over the 3-year contract period, threatening litigation for fraudulent billing practices. This complaint triggered several cascading consequences. Crawford's malpractice insurance carrier sent their own auditors to investigate. The State Consulting Board opened an investigation. And several other clients who heard about the complaint requested reviews of their own billing records. In early December 2024, I received a call from Jennifer Walsh, an attorney with the law firm conducting the malpractice insurance audit. Ms. Martinez, we understand you attend executive meetings and keep meeting records for Crawford and Associates. We need to review all documentation related to billing practices, client engagement policies, and financial reporting. Please preserve all meeting minutes, recordings, notes, and related documentation. You're legally required to produce these materials as part of this investigation. I confirmed that I would preserve and produce all requested documentation. To be clear, Jennifer continued, we need comprehensive documentation, not just official meeting minutes. Any notes, recordings, or records you've maintained regarding how billing decisions were made, how revenue was recognized, or how client relationships were managed, all of that is within scope of this investigation. I understood what she was requesting. She wanted my complete archive, not just the sanitized official minutes. I spent the next week preparing my documentation for production. I organized 5 years of comprehensive meeting notes chronologically. I indexed meeting recordings by topic and date. I created summaries showing patterns of billing practices, revenue recognition decisions, and client relationship management. The documentation I produced included complete recordings and transcripts of 287 executive meetings, comprehensive notes documenting discussions about billing practices, including explicit instructions to maximize billable hours and find ways to get more revenue per engagement, records of 34 specific instances where billing practices violated firm policies, documentation of conversations where partners discussed aggressive revenue recognition to meet financial targets, evidence of the employee misclassification decisions, patterns of expense manipulation to meet quarterly EBITDA targets. I produced this documentation in January 2025 in response to the legal investigation. I didn't editorialize. I didn't highlight specific violations. I simply provided the complete, accurate records I'd maintained as part of my job responsibilities. The auditors spent 3 weeks reviewing my documentation. In early February 2025, Jennifer called me for a follow-up interview. Ms. Martinez, your documentation is extraordinarily detailed. These meeting recordings and notes show explicit discussions about billing practices that appear to violate both your firm's stated policies and professional standards. Were you aware that these practices were problematic when you were documenting them? I knew they contradicted policies and previous guidance from the CFO, I replied. But I'm an administrative assistant. I document meetings. I don't have authority to question executive decisions about billing or financial reporting. Did you ever raise concerns about these practices? Once, in September 2024, I questioned a discrepancy in financial figures during an investor presentation. I was told I was just a secretary and wasn't there to question financial details. Do you have documentation of that incident? Yes. Meeting recording, transcript, and comprehensive notes from September 14, 2024. Jennifer paused. Ms. Martinez, your documentation is going to be central to this investigation. The patterns you've documented suggest systematic violations of billing standards, accounting principles, and professional conduct rules. This is significantly more serious than the single client billing dispute that triggered the investigation. The audit expanded dramatically. Additional investigators were assigned. The State Consulting Board escalated their review. And Crawford and Associates Board of Directors was informed that the firm faced potential civil penalties, required financial restatements, and possible loss of professional certifications. On February 18, 2025, Crawford and Associates Board called an emergency meeting. I was summoned to attend as a witness rather than as a minute taker. Present were all 5 board members, Martin, Daniel, Patricia, external legal counsel, and audit representatives. The board chair, Elizabeth Morrison, opened the meeting. We've reviewed the audit findings and the documentation provided by Ms. Martinez. The evidence shows patterns of billing violations, aggressive accounting practices that may constitute financial misreporting, employee misclassification, and misrepresentations to investors. Ms. Martinez, your documentation is the primary source for these findings. Can you explain what we're seeing in these records? I maintained comprehensive meeting notes as part of my job responsibilities, I said. The partners approved audio recording of meetings for accuracy in minute preparation. The documentation reflects what was actually said and decided in meetings over 5 years. These notes show explicit discussions about manipulating expense recognition, billing for hours not worked, and misclassifying employees, Elizabeth said. Why didn't you raise concerns when you were documenting these discussions? I raised concerns once, in September 2024, about financial discrepancies during an investor presentation. Mr. Crawford told me I was just a secretary and wasn't there to question financial details. I understood that my role was to document meetings accurately, not to challenge executive decisions. Martin spoke up, his voice tight. Rebecca, you took those recordings and notes out of context. Those discussions were about business judgment and strategic decisions, not violations. You're making normal business conversations sound like criminal conspiracies. I documented exact quotes and context, I replied. The recordings and transcripts show what was actually said. Anyone can listen to them and read the full context. Daniel added, you've betrayed the trust we placed in you. We allowed you to record meetings for administrative purposes, not to create a surveillance archive to undermine the firm. I created comprehensive records because that was my job, I said. You asked for accurate meeting minutes. I maintained detailed notes to ensure accuracy. You approved audio recording for that purpose. I produced those records when legally required during an investigation. That's not betrayal. That's compliance with legal obligations. Elizabeth cut off the partners. The documentation speaks for itself. The board has reviewed the evidence. The audit findings are based on your own recorded statements and decisions. The question now is what consequences are appropriate. Over the next 2 weeks, several significant developments occurred. The malpractice insurance audit concluded that Crawford and Associates had engaged in systematic billing violations that would not be covered by their policy. The insurer denied coverage for the Midwest manufacturing claim and canceled the firm's policy. The State Consulting Board concluded their investigation and issued formal sanctions including a $340,000 penalty, required restitution to affected clients, mandatory compliance training, and 2 years of enhanced oversight. The Securities and Exchange Commission opened an investigation into whether Crawford's financial misrepresentations to investors violated securities regulations, particularly given that the firm had been seeking investment capital based on financial presentations that didn't match internal reality. Crawford and Associates Board conducted their own governance review and concluded that the partners' conduct violated fiduciary duties and professional standards. On March 4, 2025, the board announced that Martin Crawford and Daniel Reed would be stepping down as managing partners and would be transitioning to advisory roles with no management authority. The board offered me the position of Director of Governance and Compliance, reporting directly to the board, with responsibility for implementing enhanced oversight, internal controls, and documentation practices. The role paid $95,000 annually, an 83% increase from my executive assistant's salary, and included authority to attend all executive meetings and report directly to the board regarding compliance concerns. I accepted the position on March 7, 2025. On March 12, 2025, I saw Martin in the building lobby. He was clearing out his office, carrying boxes to his car. When he saw me, he stopped. Rebecca. I hear you're Director of Governance and Compliance now. Quite a promotion. The board needed someone who understands documentation requirements and takes compliance seriously. You destroyed my career with those recordings, Martin said. You sat in meetings for 5 years taking notes. Like a spy, waiting for opportunities to undermine us. I sat in meetings for 5 years taking accurate notes like you asked me to, I replied. You approved audio recording for minute preparation. You wanted comprehensive records. I provided them. When an investigation required producing those records, I complied with legal obligations. What destroyed your career wasn't my documentation, it was your decisions that my documentation accurately recorded. Those were business decisions made in context. You made them sound like violations by stripping away the business judgment nuances. I documented exact quotes with full context. Anyone can read the transcripts or listen to the recordings and see the complete conversations. If your business judgment involved directing staff to manipulate expense recognition to meet EBITDA targets, misclassify employees to save benefits costs, and bill clients for hours not worked, that's what the documentation shows because that's what happened. Martin's expression hardened. You could have warned us. You could have told us that you were keeping detailed records that would be used against us. You approved the recording. You knew I was taking notes. You called me just a secretary when I questioned financial discrepancies. You treated me like furniture in meetings, speaking freely because you assumed I wasn't really paying attention or didn't understand what you were discussing. That was your assumption, not my deception. I was doing my job. You weren't doing yours ethically. The board overreacted, Martin said. The violations they're claiming aren't material. This is all being blown out of proportion. The state consulting board issued a $340,000 penalty. The SEC is investigating securities violations. Your malpractice insurer canceled coverage. Multiple clients are requesting billing audits and considering legal action. That's not an overreaction. That's a regulatory and legal response to documented patterns of violations. You made decisions that contradicted policies, professional standards, and accounting principles. I documented those decisions accurately. Those documents became evidence when investigators reviewed them. The consequences you're experiencing are the results of your choices, not my documentation. Martin walked away without responding. 3 months later, the SEC concluded their investigation and issued civil penalties of $580,000 against Martin and Daniel personally for material misrepresentations to investors. Crawford and Associates was required to restate 3 years of financial reports and implement independent financial oversight. My role as Director of Governance and Compliance involved rebuilding internal controls, implementing ethics training, creating whistleblower protections, and ensuring that all employees, including administrative staff, understood they had both authority and obligation to raise compliance concerns. I also implemented a new meeting documentation policy requiring that all executive meetings be recorded and transcribed, with transcripts reviewed by compliance before any significant financial or operational decisions were implemented. Administrative staff who attended meetings were given explicit authority to flag potential compliance concerns and were protected from retaliation for raising issues. The administrative assistant who replaced me in supporting the new managing partners was paid $68,000 annually, 31% more than I'd earned in that role, and reported that the partners treated administrative staff with more respect than the previous leadership had. Here's what they don't teach executives about administrative staff: we're not furniture. We're not invisible. We hear what you say in meetings. We understand more than you think we understand. And when you approve audio recording 4-minute preparation, you're approving documentation of everything said, not just the things you want documented. Martin thought just a secretary meant someone who took shorthand and scheduled appointments. What it actually meant was someone with comprehensive documentation of 287 executive meetings spanning 5 years, including verbatim records of every questionable decision, every ethical shortcut, and every time leadership prioritized favorable optics over accurate representation. The math is simple. Crawford and Associates paid me $52,000 annually to document meetings. They authorized audio recording to ensure accuracy. I documented accurately, more accurately than they realized, and maintained comprehensive records as part of my job responsibilities. When legal investigations required producing those records, my documentation became evidence of systematic violations that resulted in $920,000 in civil penalties, forced restatements, canceled insurance, lost clients, and leadership changes. You want to treat administrative staff as invisible furniture who won't understand financial discussions? Go ahead. But remember that just a secretary might be taking more detailed notes than you realize, And not there to question financial details doesn't mean not documenting financial details accurately. Martin called me just a secretary while presenting inflated financial figures to investors. The SEC called my documentation material evidence of securities violations while issuing $580,000 in civil penalties. The board called me Director of Governance and Compliance, while implementing the oversight systems that should have existed before executives assumed that administrative staff weren't paying attention. 5 years of silence, watching executives speak freely in meetings because they assumed I was too junior to understand or too powerless to matter. Then one investigation requiring documentation production, and 5 years of comprehensive records became evidence that executive conversations contained explicit violations that couldn't be explained away as business judgment. I kept my Sentra with 112,458 miles. I kept my external hard drives with encrypted meeting recordings. I kept the practice of taking extremely detailed notes because accurate documentation protects everyone, including administrative staff who get called. Just a secretary, by executives who don't realize that secretaries often document more accurately than executives prefer. Martin and Daniel are no longer managing partners. They're paying $580,000 in SEC penalties. They're explaining to their professional networks why their consulting firm imploded under regulatory investigations. And they're learning that, just a secretary, who documented 5 years of meetings maintained better records of what they actually said and decided than they maintained themselves. Sometimes the person sitting against the wall taking notes is the only person in the room creating an accurate permanent record of what was actually said. And sometimes, just a secretary becomes the evidence that ends careers built on assumptions that administrative staff don't understand, don't matter, and definitely aren't paying attention to the exact words executives use when they think nobody important is listening. 5 years of silence, then one reveal that ended it all. Except it wasn't a reveal. It was just compliance with a legal obligation to produce accurate documentation during an investigation. The fact that the documentation was comprehensive enough to prove systematic violations wasn't my choice. It was the natural result of doing my job thoroughly while executives did theirs unethically.